What if the largest empire on earth never raised a flag? What if it ruled not with armies, but with interest rates? What if every crisis you've lived through wasn't an accident, but the output of a machine designed to make crises inevitable? Welcome to the invisible empire built on debt, control, and manufactured shocks. And no, you don't need a conspiracy to make it real. You need incentives, institutions, and a system that feeds on volatility. Here's the mystery we'll untangle. Why do financial fires keep breaking out in different rooms of the same house? Why do the people who start with the matches end up selling the water? And why does the house keep getting bigger after every blaze? To see it, we have to go back, before Wall Street tickers, before central banks, back to a time when power first learned to borrow the future. When kings ran out of gold, they didn't stop fighting wars. They invented IOUs. Merchants financed voyages with bills of exchange. Trust was the new currency, and those who could create trust created power. In 1694, the Bank of England pioneered a model that would echo for centuries. The crown needed money. A private bank provided it. In return, the bank got the right to issue notes backed by government debt. The state borrowed legitimacy from the bank. The bank borrowed power from the state. Debt was no longer a begging bowl. It was a machine. Then came bubbles and panics. The South Sea Frenzy, Panic of 1825, railway booms and busts. Each disaster did something subtle. It pushed society to accept more central control for stability. Each bust didn't end the system. It upgraded it. Across the Atlantic, the United States faced its own pattern. Early experiments with national banks collapsed. Private credit stretched and snapped, again and again. The 1907 blew the doors off. Trust companies failed. Bank runs spread. A group of financiers tested a new idea in secret. The result arrived in 1913, a central bank with a mandate to steady the system by controlling money, credit, and the price of liquidity. That promise changed the tempo of history. World War I demanded financing on a scale never seen. Open market operations became policy. Interest rates turned into levers. The Great Depression crashed the experiment, but also redefined it. Banks failed. Depositors lost everything. The fix: deposit insurance. Lender of last resort fire hoses. The state would now stand behind the banking system, and the system would stand behind the state. But the real turning point came after World War II. Nations gathered to rebuild trust in money itself. Bretton Woods created a dollar anchored to gold, and other currencies anchored to the dollar. It looked like order. It felt like stability. Under the surface, pressure built. By the 1960s, the design was creaking. Global trade grew faster than gold. Dollars piled up overseas. Foreign central banks asked for metal instead of paper. The US faced a hard choice: defend gold and shrink credit, or break the link and let credit expand. In 1971, the link snapped. Gold convertibility ended. The dollar floated. The empire found its true fuel: unlimited, elastic debt. How do you preserve demand for a currency no longer tied to metal? You create new anchors. In the 1970s, oil priced in dollars became that anchor. Energy producers took dollars. Surplus dollars recycled into U.S. assets. The petrodollar loop was born. A new offshore banking world exploded: the eurodollar market. Credit could be created outside domestic rules. On balance sheets you couldn't see. Shadow banking found its daylight. Deregulation in the 1980s accelerated the engine. Derivatives let risk be sliced, diced, and sold. Notional amounts today exceed $500 quadrillion worldwide. That's a number too big to picture. Yet it sits on a thin layer of collateral and confidence. It works until it doesn't. Each crisis revealed the blueprint. 1987 crash, savings and loan collapse. L2CM in 1998, an early to interconnected to fail warning. .com bust in 2000, the lesson learned by markets. When things break, the central bank cuts rates. When cuts aren't enough, it expands its balance sheet. When that's not enough, the state writes checks. Risk gets socialized, profits stay private. Then 2008 pushed the cycle to the edge. Mortgage debt had been transformed into securities that looked safe. They were safe only if house prices never fell, borrowers never defaulted, and funding never ran. All three failed. The modern bank run didn't happen at ATMs. It happened in the repo market and in money funds. Lehman fell, AIG imploded, the wiring of global finance lit up, and every circuit screamed. The response rewired the empire again. Quantitative easing turned central banks into the largest buyers of government debt and mortgages. Rates went to zero, then below zero in parts of the world. Zombie firms survived because servicing debt was cheaper than breathing. Markets learned a new phrase, whispered with awe and fear, whatever it takes. Here's the twist, whatever it takes works in the short run. It extends the game, but it also deepens dependence on the very medicine that made the patient fragile. Rules tightened after 2008. Capital buffers improved. Trade reporting got better. Big banks got safer. So the risk migrated. It moved into shadow banks, private credit, hedge funds, and liability-driven strategies. The system didn't shrink. It changed shape. In 2019, a quiet market suddenly screamed. Overnight repo rates spiked from 2% to nearly 10%, a plumbing problem. Yes, but also a signal. Even routine funding was fragile when everyone relied on the same collateral and the same short-term loans. Then the pandemic hit. Demand collapsed, then surged. Governments issued oceans of debt. Central banks bought them. Households got checks. Asset prices ripped higher. Money supply jumped at a speed almost no one had seen. Inflation woke up after a long sleep. The cure for deflation became the cause of inflation. Rates rose to fight it. Another weakness emerged. Portfolios built for near-zero rates couldn't handle the shock. In the UK, pension strategies tied to long-dated bonds buckled. Yields spiked. The Bank of England stepped in to stop the spiral. In the US, regional banks holding long bonds saw deposits flee. Silicon Valley Bank failed in days. The solution? A new lending facility that valued collateral at par, not market prices. Again, the pattern: stability through extraordinary support, support that encourages more risk. If this is an empire, who rules it? Not a single villain in a smoky room, it's a network. Central banks setting the price of time, treasuries issuing the raw material sovereign debt, banks and non-banks transforming maturities, investors searching for yield in a low-rate world, politicians promising growth without pain, everyone doing what the system rewards. Crises aren't always planned, but they are manufactured by incentives. Look at the data today. Global debt sits above $300 trillion, larger than the entire global economy several times over when you count public and private together. Government interest costs are now among the fastest growing budget lines in many nations. Around half of U.S. investment-grade corporate bonds are rated at the lowest rung of investment grade. A downgrade wave would force massive selling. OTC derivatives notional amounts exceed $600 trillion worldwide. That's too big to unwind smoothly in a panic. And wealth concentration has climbed with each cycle, a sign of the Cantillon effect. Those closest to the money spigot benefit first and most. The pattern repeats with eerie rhythm. Leverage rises in good times. A shock reveals fragile funding. Collateral gets questioned. Liquidity vanishes. A rescue restores confidence by expanding the very structures that cause fragility. After each rescue, the empire grows. More debt, more scope, more reliance on policy. And yet, there's agency here. We are not spectators, we are participants. Understanding the machine is the first defense. So, what breaks it? Sometimes, it's something small in the wrong place. A default in a corner that cascades through collateral chains. A failed auction for government bonds. A mismatch in the shadows that becomes a sprint for cash. Other times, it's something obvious. Debt service outruns tax receipts. Voters refuse austerity. Inflation refuses to obey. In every case, The same question returns: who provides the backstop, with what credibility, and at what price? One more paradox: the empire says it delivers stability, but it depends on growth that must be pulled from the future. When growth slows, the machine compensates with more credit, not more productivity. That gap is the fuel for the next blaze. Does this mean doom? No, it means design choices. It means trade-offs. It means accepting that a system built on maturity, transformation, and leverage will always oscillate between calm and crisis. If we expect calm without reform, we feed the cycle. What would real reform look like? Cleaner plumbing, transparent collateral, less reliance on short-term funding for long-term assets, counter-cyclical buffers that actually shrink in booms and grow in busts, fiscal honesty matching promises to tax bases, monetary humility accepting that not every problem is a rate problem, and a shift from debt-driven growth toward investment in real productivity, energy, infrastructure, education, and innovation that pay in cash flow, not just valuation. Until then, watch the signals, watch the places where risk hides, off-balance sheet commitments, rehypothecated collateral, non-bank lenders promising daily liquidity on illiquid assets. Watch the politics. When the cost of debt crowds out everything else, policy gets sharp, and sharp policy cuts quickly. 3 takeaways you can carry with you. Follow the plumbing, not the headlines. If you want to know where power sits, track who sets collateral rules, who can create credit, and who gets the backstop when things break. Crises are features of the design, not bugs. Maturity, transformation, and leverage create growth and fragility at the same time. Rescues protect the core while extending the cycle. Build personal and civic resilience. Keep your own balance sheet flexible. Understand your exposures, and support reforms that reduce hidden leverage and increase transparency. Here's the warning: every rescue raises the bar for the next rescue. At some point, the backstop itself becomes the question. Confidence is the final collateral. Guard it carefully. If this changed how you see the world, share it. If it challenged you, subscribe for more deep dives. And tell me in the comments, where do you see the next weak link and who stands ready to profit when it snaps?